Welcome to Inveniam's podcast on the future of decentralized finance. I'm super excited to be here with my collaborators, Rick Bunker, who's CTO here at Inveniam, Albert, who runs our AI business unit, and Kevin, who's our chief data scientist. And we are super excited to have Richard Walker joining us as we kick off this series. Richard, give us two minutes about yourself.
Thanks, Pat. It's great to be back. Happy to be here. Partner at Bain Company in the New York office. I co-lead our global Web3 practice. We serve traditional finance institutions, from large global banks to asset managers, to broker-dealers, to custodial banks. And our mission really is to work with those organizations to help them make the change necessary to move from the current global financial market infrastructure based on a fragmented set of rigid capabilities with great opacity and slow processing times at high expense, to a future which looks very different based on decentralized finance capabilities.
Yeah, and in some of our conversations ahead of the start of this podcast, we were talking about how we get there. And Richard, I really loved your perspectives on that. But as I see the destination, right, of where we're going to go, I think of the Seinfeld episode, right, where they're going, they have to go downtown, and they're in the car and they're arguing the whole way about the best way to get there. Right? No, we got to go this way. No, we got to get this way. Right? Then everybody sees the destination. We're going to go there, and they're all arguing whatever, right, about which way to go. And the driver, Jerry was yelling back. And how we get there is open to interpretation. Will we get there, and what does it look like, and what is this destination? I think we can articulate pretty clearly from Inveniam's standpoint what we think that looks like in a fully decentralized environment where there's decentralized ledgers, right? That people are agreeing on who owns what, and there's many nodes agreeing on that. Where there's compute, and some of that compute is going to be attached to the instrument, some of it's going to be decentralized. Mm-hmm. You're going to be borrowing that in a SaaS environment where you're using other computer programs, you're proving data going in and what's coming out. There's going to be zero knowledge proofs for private data. There's going to be public data, and then there's going to be decentralized data, doing away with centralized data repositories that is the single referenceable database. And as we, in this networked world, begin to reimagine the microservices that have been consolidated in traditional capital markets, and those microservices get high functioning, in some ways automated by AI, but we need to prove attribution, origin of that data, and authenticity. Some of it's going to be done where there's people doing just very specific functions, distribution, structuring, oracles, et cetera, right? As we think about that, but my question to you, Richard, is how are we going to get there? What is the path? And what does that look like, as the end game, as far as the functionality and delivery that this next generation of capital markets is going to deliver?
Pat, a good friend of mine recently introduced me to a book called The Lion Tracker's Guide to Life. The author is Boyd Vardy. And it's a really fascinating reflection on this step-by-step of focus and dispersed view. Like, focus of what's in front of you and disperse your view to keep an eye open towards a changing landscape. And a quote from that, it's really a principle that I think is very appropriate here, is they say, I don't know where I'm going, but I know exactly how I'm going to get there. The I don't know where I'm going is really driven by there's no way to look on the horizon at a fully instantiated decentralized finance future where capital markets operates on a blockchain architecture with all of the attributes you describe, and know how to get there. I don't know where I'm going, but I know exactly how I'm going to get there. It's each step. And so it's building the primitives along the way that are so critical, and focusing on those primitives in the short term and dispersing your view to understand the changing dynamics of the landscape. That's something that, really, helped me to think about where we are in this journey. We're probably, I don't know, it's great to quantify things. We're probably 5% on the journey, Pat. We're only just beginning. This journey is very early with regard to, what's being built, how it's being built, and what's being built today and how that'll look in the future. It's a matter of, finding a print and then using that to find the next print, not to go directly to the end. And there are multiple tracks happening at the same time, and they're moving at an uneven, pace. And it's about getting in the reps. As I was preparing for this, Pat, I was, really thinking about the journey being, uneven and seemingly undesigned. Like as, primitives are launched, changed, relaunched, and will, finally come together in the mosaic that we have in the future. But we can't just go straight there. Pat, that, God created the world in 6 days, but he did not have a legacy environment to support. Right? That was the quintessential, instantiation of engineering elegance. But it didn't have to, bring other elements forward the way that we do in today's global financial markets, which is why, we're likely 5% of the way forward. There are some exciting things happening, no question. We have a clear view on, many of the elements that are required to bring that future forward. But as I said, they're in different stages of development. Here at our shop, we have a view of really 9 characteristics that need to be instantiated for the delivery, of this environment. Functional characteristics. I'm going to describe to you 9 functional characteristics, and then what does the centralized versus decentralized implication of each of those mean? And quickly, wallet infrastructure on the front end, apps to be able to initiate a transaction. Digital identity, so who is processing, on either end of that transaction leg. On-chain currency at scale, and currency doesn't necessarily mean money. It means something of value. You might be using carbon credits to settle a transaction. Digitally native representation of financial products, and other things of value. Digitally native, not just a digital twin and not a tracker or a registry, but native. Verified data about those products, providing timely, accurate, reliable data to all market participants. And that's where you come in, Pat. Price discovery mechanisms, you come in there as well. A processing architecture to imbue assets with functionality, and rule sets, right, to assure, consistent application of rules. Marketplaces with automated market makers to provide liquidity across blockchains. And then wallet infrastructure on the back end for the secure holding, institutional grade custody. All of those things, will need to be in place. Arguably, all of them are under development. The development that's happening today isn't necessarily going to be the development that wins, because we're going to learn lessons and we're going to lose track of that destination, because when we disperse, we get new information and then we reset. But what do those things have to do with decentralization? What's the role of decentralization in those things? Is decentralization required to deliver any of them, or to deliver utility? Can centralized instantiation, operated by central parties suffice? As a matter of legal recourse, regulatory compliance, and investment governance, it's likely there's going to be some intermediation in the delivery of these capabilities. We believe that, this is not the no intermediated, fully decentralized, sovereign future for market participants. We believe that there are roles. The biggest role is likely when you go one layer down into the non-functional attributes, Pat, where you really see the value of decentralization. And that's going to be evidenced in, and I won't speak to it, I'll just stop there. It's a long intro, but it is, I'm trying to, bring some color and texture to your question. Those non-functional things which really disproportionately benefit from decentralized instantiation, is its resilience, its scale, its interoperability, and its processing integrity. Right? That's where decentralization really differentiates. And if you think about the functional characteristics, those 9, on top, delivered in various forms, could be, intermediated if there's value and the rent seeking isn't too egregious, on top of a decentralized infrastructure to deliver those other characteristics. I think that, since we last spoke, the clarity on that and the state of the market, the state of development, and the duration that's going to be required to bring all of this to life has really become far more clear.
Yeah, I want to just give a quick response, and then Albert, I think you were going to jump in as well. I want to give a quick response to that about the does it need to be centralized? Does it need to be decentralized? And I think an architectural first principles discussion around what the cost of centralization and what the benefit of decentralization causes to the network and the networked possibility and innovation, right? And preservation of of the incumbents, right? And those financial market intermediaries and utilities that need to play a role as we go from a global to a local jurisdiction where we're meeting the local regulatory obligations and requirements, and then we're existing at an infrastructure level on a global market where multiple financial market utilities can interact in a regulated manner. And what does that look like, and where do we want centralization and decentralization? I think that's a huge topic. In addition, I would throw out one comment. You gave the kind of these 9 functions or characteristics that need to be looked at, which was great. In the early days, Inveniam, when we were talking about a transaction, we were saying we need logical discourse, right? If you're going to engage in logical discourse, you need a couple of things. You need a principle of non-contradiction that exists digitally. Satoshi did that with preventing double spend. Do you know what I mean? And we need a principle of identity, right? Which you talk about, right? And then the principle of the excluded middle, which is good data where you can go focus the argument just on those 2 elements so you can have a bid to ask, right? And Inveniam has always what you talked about, verifiable data, price discovery, and the ability to warrant all the other elements that go into a price when you buy a building. As an example, you need to say, here's a warranty on the that there's no hazardous materials, that the foundation is good, whatever it might be. Here's the rents; those are reps and warranties. Well, Aristotle called that the principle of the excluded middle, right? So where he wasn't talking about reps and warranties and bid and ask, but he was talking about logical discourse, how you can come to a conclusion on an argument. As we talk about whatever our framing principle is, and your characteristics in framing is fantastic. And I love and I threw that out kind of how Inveniam thought about this at the very beginning of our data architecture and what role we were playing, that we were the digital principle of the excluded middle, which was not a great byline that people used to kick me all the time. In fact, don't say that out loud. But literally it is, how do you get to the point where everybody agrees on all the parameters so you can just focus on bid ask? Right? So market makers and automated market makers and exchanges can actually work together. And I look at this and I say, your comment about, I don't know how I'm going to get there. You know what I mean? Or I know how I'm going to get there, but I don't know what it looks like. That experimentation. One of the things.
It's actually the inverse. It's, I don't know how I'm going to get there, but I know exactly where I'm going.
That's exactly right.
Yep.
I mean, there's a lag on your video and audio, which makes you look a little bit like Max Hedstrom for the older folks. But at any rate, I think you're exactly right. Albert, you were going to make a comment.
Yeah. So I think what's clear about this episode is that there's a wealth of knowledge available, but for the benefit of viewers who might be like me and not have the benefit of decades of experience in the global financial markets, we've heard a lot of promises over the years about DeFi, and adoption seems to be the biggest problem. We heard that you're going to be able to pay with Bitcoin at the coffee shop, and so far that type of thing hasn't materialized. So for the benefit of just viewers who engage with the financial system on a regular basis and may not even know it, because there are mechanisms that are behind the scenes or infrastructure that they don't truly understand but affect their lives. Can you explain one aspect or perhaps one weakness or inefficiency of the global financial system that it seems promising that there will be a DeFi solution to it? Maybe Richard, if you could opine on that.
And we're already seeing this, intraday liquidity through intraday repo trading, which wasn't possible before without this technology. And hopefully, I'm not doing max headroom. I plugged into the wired, network here, which should be high speed. The current market conditions, require a far more responsive ability to manage liquidity on a day-to-day basis. Previously, repo trades were all done overnight. So you would post cash collateral. It would go into a purchase of treasuries. You would sell them next morning. You would get yield on that. You'd get your cash back. The ability to collateralize, to immobilize and collateralize, tokenize collateral, immobilize, tokenize collateral, post those tokens against that collateral to be able to, participate in a repurchase agreement of treasuries intraday to gain a yield on lazy cash, and then return that yield is something that simply is not possible without a more responsive technical infrastructure and architecture. And so that's one example. If you're looking for a retail one, I don't think you were. I think we're talking institutional here, but my wife recently paid our Amex bill by doing an ACH from our bank to Amex, and that was done on Tuesday. And I got a notice from Amex that it's still due. So we're still waiting for that Tuesday ACH from the bank to Amex to pay the credit card bill to move. It's absurd. It's ridiculous. The speed, the transparency, immediacy, which is the same as speed, but like to know, I said do it, it's done, it's been settled. That is going to be transformational to the way that consumers experience financial services products and investing, similar to the way that they're seeing on some low cost retail trading platforms. But it's going to be even more impactful within the institutional cross-border global market environment where you have complex multilateral trading activity taking place, which is going to reduce counterparty credit risk. It's going to free up trap liquidity that is held for the completion of multi-day settlement scenarios, and it's going to allow the immediate reuse of a trade asset or collected capital against a sold asset to be redeployed in a productive manner. There's a governor on the global economy, which is the broken, fragmented, visible, and opaque financial system. If you remove all of those governors that slow down global commerce, we will see a productivity lift and creation of wealth that we have only just begun to understand.
And this gets to all forms of reconciliation, right? And every time, and whether you're reconciling collateral, which has been immobilized, you're reconciling a trade and settling it immediately, or you're reconciling data over complex computation, pre-trade, post-trade to service an asset, to come up with a mark on an asset, the more reconciliation, it is a logarithmically more difficult when you're doing it manually, because the previous person is checking not just the previous person's, but the two previous persons' work that they're doing. And when you have 8,000 people at Bank of New York and their sole job is reconciliation, you go, that's going to go away. That is going to 100% go away. Now, not only is it going to go away, but in addition, if we try and maintain that standard and that system, when data collection is growing also at a logarithmic rate, you know what I mean? It's not like we're collecting less and less data, right? We're collecting more and more and more data. that different people are saying, I find this data useful. And to the degree we need to reconcile it, or we need to consolidate it into one location. Oh, the only place we trust data is from this one, Oracle or repository. That is a governor on data-rich, low-frequency trading assets, right? The private markets. And this is why it's interesting, because the incumbents, a lot of the big banks, they love these tokenized real-world assets, meaning a tokenized treasury, a tokenized money market fund, a tokenized security that can trade and settle real time, right? What we see Ondo and BlackRock doing on Securitize, and the ability to trade these things 365, and the money and the deposits, the liability networks, where they're literally trading and settling instantaneously. Man, that's the easiest thing for them to adopt. Now go to the exact opposite end of the spectrum, where there is no legacy infrastructure, the alts. You know what I mean? Where there is not a big buildup of infrastructure, and they're envisioning, how do we tackle and gain these massive market share as we leapfrog landline, so to speak, and go straight to cellular. You know what I mean? They're skipping that investment of the 80s, 90s, and aughts, where they were literally building all this infrastructure that they don't need to reconcile with, where they have the ability to create the world in 6 days, right? And then rest on the 7th. And to go back to yours, Albert, keep going, brother. I'm sorry for.
Well, no, those were wonderful, and I'm going to hand it to Rick in a moment here. But I just want to remind all of our viewers, if you have questions, feel free to drop them in the comment box below, and we will make sure to get to them at the end. Rick, what do you think?
So I had a few comments. Richard, I've loved what you've had to say. Although I was interested, you brought up two things. One is repo markets, right? Where people take lazy cash and get a return on it by lending against very liquid securities that they can accelerate on if they need to. And then your ACH transaction taking 3 days. Because the bank holding on to your money for the 3 days while the ACH transaction settles is where they get the money to put into the repo markets.
Should be mine.
If we solve one problem, we might make a cash squeeze on the other problem, right? But I think and then Pat, you had a lot to say about the information about the assets, especially these less frequently traded private market assets, right? When we're talking about a treasury versus a US dollar, right? Those things are fully known, fully understood, fully documented, publicly traded already assets. But if you think taking 3 days to pay your Amex bills a drag, imagine how long it takes to realize liquidity from the shopping mall that you own, right? That's not a 3-day settlement or transaction duration. It's a 6-month. And by collecting the information in a distributed fashion and a permissioned fashion, because it's private, it also can't be made public the way all of the annual reports for public securities are out there. People don't want to put private market information out there. And yet, if we're to make parts of the capital stack, the equity, the debt, whatever, about these private assets tradable, we need robust, complete, trustworthy, permissioned information about them
At scale.
And that's a huge opportunity, I'll say, right? It's an area of future strength for trading real world assets.
And Rick, as we think about that, and we think about DeFi lending into real estate or private equity or lending into all of this, we need the price discovery, we need the good data, we need market makers, we need wallets, we need all these functional characteristics that Richard talked about in order to do that. But what are the markets that are going to come? Because if we can deliver price discovery first, we may not be trading the underlying. It may be the world's first derivatives market for real estate being built at a regulatory environment that is pro that, where you're not trading the underlying, but indices and options and repo against a whole new asset class, because you have trusted, high-functioning price discovery on the underlying itself opens up. And then maybe secondary markets and new forms of primary. And this is where we're not sure which one's going to take off first and where mass adoption is going to occur. But what you're seeing is these elements open up in order to deliver whole sets of new functionality. And lazy cash, there's some locked value there. But when you talk about real estate and private equity, boy, that's locked value. You know what I mean? And infrastructure, maybe the largest amount of locked value there is. Go ahead, Richard.
All real estate is lazy, is the takeaway there.
Pat, I was just going to say that, what you described, there's like, and forgive me for this, but it's small game tracking. Creating new markets, derivatives against real estate, like it's interesting and allows you to get in reps and allows you to find a footstep and then follow that footstep in the journey of tracking to a destination that will be, interesting. Along the way, you may, in your focus disperse steps, see new opportunities. But there's elephants, there's lions, there's hyenas, and there's bunny rabbits, right? That can be tracked here. Not all of these things are the same, and not all of them are going to yield the same level of value, but it's going to give you the reps in the tracking, right? Which can be applied within a new context to go after the big game once those skills and the capabilities for tracking are refined. And, I think you're talking products. I also think about jurisdictions, because one of the things that we have to be attendant to in this discussion is the regulatory perimeter. Right? The regulatory perimeter is something that, it's the fence around the game preserve. And, you have to operate within the rule set, in that preserve. And you go to different preserves for different rule sets. You might go to Abu Dhabi Global Markets. You might go to Monetary Authority of Singapore, into Product Guardian. And, these are, smaller preserves that allow you to, perfect your reps and to build your skills. But those skills are being developed for purposes of bringing them back to the open, right? The open wild. And the open wild is the U.S. markets. It is the deepest, most liquid capital markets in the world. And, the things that you can do and can't do here drive you to go to those smaller preserves outside of this open wild to build those skills and capabilities. And one thing that we need to acknowledge is that what might seem like something that's subscale, insignificant, and won't move the needle, absolutely, are the things that we need to be doing to better understand the functional, non-functional performance characteristics, interoperability, and overall, architecture of what the future markets will look like. So, if we have by the end of 2030, 10% of global volume on blockchain, that'll be a massive win. 10% by the end of the decade would be huge. That would be trillions of dollars of value moving every single day, but it would still only be 10%. And so this, the effort here is significant. And we know where we're going. Pat, you know where you're going. We just don't know how we're going to get there yet. We only know one step at a time.
Yeah, and this, I really think that this also gets to the characteristics, and Clay Christensen, right? How do we define the early adopters, right? Who do we define as the early adopters, and what are the advantages they're going to have versus the fast followers, right? And we are going to have an E-Trade. We are going to have a Schwab. We are going to have some of these innovators who are getting into commission brokerage, when we deregulated brokerage fees and these discount brokerages, and who went online at discount, and all of a sudden, names that today are known or have been subsumed and are large parts of online banking. Let me tell you, those disrupted some of the biggest names in banking, right? And those names are trading. And we're going to see the same thing. And when we see, jurisdictions, which matter a ton, as well as where there is a lot of clean slate, those early adopters. So, what are the dynamics that are going to drive the early adopter versus the fast follower, who are going to fund and create critical mass. And in there's going to be some brand new franchises that are going to be dominant. Coinbase, I would use as an example, right? Coinbase as a financial powerhouse is there. They're on the map, and 10 years ago, they were not. They weren't even close to on the map. Yet their firepower today and their ability to be talked about as a key infrastructure player and determinant about the future of capital markets, it's hard to talk about that in any institutional setting and not mention them.
Wow. Yeah. Kevin, what do you think?
I'm going to ask a retail question of Richard, or what I think is more relatable at that end. In the list of 9, one of them was digital ID, and the other was on-chain currency at scale. And I'd just like to get at Inveniam, on-chain ID usually means a tokeny ID for a security. But WorldCoin is also saying we're going to have an identity for every human out there. And they also propose that the WorldCoin could be that currency at scale. But around the office, we're usually thinking of USDC. So I'd like you to just talk about how those two things work together, digital ID and on-chain currency at scale, and and maybe just a little bit of response to who do you think that's doing it well, or who has set a good pattern, even if they're not the ultimate winner in digital ID and currency at scale.
It's very early with regard to digital identity because there's been lots of starts and then retracements. You find a step and you think that you're on track, and then you come to a river and you lose track and you reset. Right? That's where we are in digital identity, because whitelisting is wholly insufficient to provide the level of surety and compliance, particularly cross-border, cross-asset, cross-chain, cross-jurisdiction, and so what we need is beyond the WorldCoin. I have a WorldCoin wallet, and I went and I had my iris scanned, and so they know that I'm a human. It's all they know, as far as I know. They might know more, but as far as I know, they only know that I'm human. Digital identity, fully elaborated, is all of the protected information about me, financial history, assets owned, educational history, hobbies, medical, and it's something that I can use, zero knowledge proof to share information for any type of transaction, whether it's financial or medical or other. That's the kind of fully instantiated, rich digital identity we're talking about. So, that set of standards, the number of organizations have worked on it. People have published, white papers around the standards, what it could be. Some big banks have invested time to advance that, but it hasn't yet hit a tipping point. There's not, agreement and momentum around that. It's disappointing because that would unlock, a lot of the friction, right, and resistance that exists in being able to move this forward. On the currency, that's a tough one because USDC is interesting. Stablecoins are interesting, but the more stablecoin you have, the more you impair more you impair credit formation. And so there's going to be multiple different instantiations of currency types, different things that are going to be used for settlement tokens, and it's going to be contextual. It's going to be based on who the user is. Stablecoin or even e-money is very sufficient for retail. The e-money that we have, for all we know, it feels real time, and the people who are recipients in those bilateral transactions, it's working. It's when you get to small business and up where you need an immediacy of a bearer instrument, an asset that you can then take and repurpose to pay a supplier, to do other things. So e-money's fine for retail, stablecoin for SMB. At the institutional level, there's no way that we could tokenize the world's money supply. There's about $77 trillion in deposits, in the world. You lock that up in a tokenized stablecoin format to settle the trillions of dollars in trade. FX alone is, $5 trillion a day in FX trading. You're going to take $5 trillion out of the credit formation and commit that to stablecoin. It makes no sense, which is why the BIS effort around Agora, and where you have a unified ledger and tokenized deposits so that you can liberate those deposits at $77 trillion in the banking system to provide for credit formation while still solving for, higher velocity, greater surety, lower counterparty credit risk in settlement activity. That's what we're talking about with, cash ledger on chain at scale. But it's not just one archetype. It's not one thing. It's a tiered architecture for, bringing a settlement asset, to the world. With a digital identity and currency to transact, the whole world opens up, Kevin.
And I want to hit there. You made many excellent points, but a couple points that you made when you're talking about different structures have different value propositions at different levels. Do you know what I mean? Of what that is, and what are the unintended consequences, and what are the perverse incentives, right? As we talk about it, for from an Austrian economics perspective, that are created at different levels as you preserve first principles. And the interesting thing is, we have around the world right now a number of large states pushing back on AML KYC overreach, right? And let's use Norway as the biggest example recently, right? But there's been about a half a dozen top 50 global economies, really top 30 global economies, who've pushed back on AML KYC on all trades. And you need things like cash, and we're, to push against government surveillance, but not just government surveillance, really legacy incumbents who are holding back the ability for people to deal back and forth with each other and not have these bureaucratic obligations, versus what you're talking about, Agora and BIS, right? Which is a centralized ledger, which is, locking in certain incumbents to the capital markets infrastructure. And I want to say, what is centralized, what deserves to be decentralized, and how we think through those various pieces. And the reason I wanted to bring up about Norway, Norway and another top 20 global economy, and Norway's been the most public about it. The other one, I was sitting in meetings with some of the leadership. They're just saying, we don't know that our citizens and our banks and our banking systems need the U.S. government overseeing every trade made globally, right? Which is a very interesting, countrywide sovereignty view, right, of AML, KYC, and Patriot Act, which has overreached. Richard, talk about that a little bit, because that's that's down at retail, not institutional, or you could take a pass on that if you want.
I'll take a pass.
In that case, Richard, there was something you said that I want to follow up on. And Pat, if we could get your response to it, actually, similar to what we were just discussing. Richard, you said that the U.S. markets are the big game. And of course, sure. You're right. That's, the world's financial markets. So, Pat, if I could get your response to that in the following way. We've seen recently a lot of regulatory uncertainty over DeFi and the potential solutions, all of the SEC drama that we don't need to rehash here. But given all of that regulatory uncertainty, have you seen other markets or other governments in the world taking the lead on some DeFi thought leadership and maybe implementing it in policy in ways that are interesting for the viewers?
Yeah, I mean, if you read Paul Grewal from Coinbase, what he writes, I think, is just gold. And Uniswap and their recent Wells notice completely ignores the federal court ruling from days before, acknowledging that the SEC's articulation of how they went off their Uniswap was wrong. And Uniswap, basically, you read Paul Grewal, and what I read, is going to win, and they're going to win in court, and that's what they wrote. And all this is a frictional transaction that is a barrier to them maintaining their primary, domicile here in the U.S. And do they want to move global? And we're seeing the UAE particularly, we're seeing Sweden, we're seeing Luxembourg, We're seeing the UK to a degree, but every time they take a step forward, I feel like they sometimes take a half step back where they hurt themselves, right? We then go to, Singapore, India, and Gift City. What they're doing there is fabulous, right? We're seeing a lot of these different people saying we want to be a global trading financial hub. UAE and Saudi, particularly recently in the last 6 months, really leaning in. But the UAE wants to be a global financial center, and they're leaning into that. And what that clarity does, it allows the innovators to exist without this Mandarin capitalism where you got to pay tokens to the Mandarin just to make sure instead of a rule of law. And I got to tell you, this is it's hurting the U.S. And the U.S. needs to maintain its leadership because it is the biggest market in the world. There is no question about that, right? That it's unequivocal. But the reality is, this does push people offshore, and it forces us to do some of these this real innovation and the next gen work overseas because there's protection.
That's where we get in the reps, Pat.
Amen.
Amen. And the innovators and the startups are the puppies nipping at the heels of the global banks, and it's kind of cute, but those puppies become significant predators and force you to run even faster. So banks aren't sitting still. Broker dealers, other participants in the global financial market infrastructure today are, the more you can innovate, the more you can, prove out the viability of a decentralized capital markets, right? The more attention you get, but the faster those organizations start to run. Right, they're not standing still.
Not by any means.
A super dynamic, interaction, in the ecosystem for what is happening in these other jurisdictions, and it's getting the attention of the U.S., but they're not going to be able to act on this for at least 3 years. There's too many distractions. There's nothing that can be done meaningfully to provide clarity until at least midterm in the next presidency, which will be the last term for whoever that president is, but that's 3 years away. And so all we can do in the meantime is go to those jurisdictions who are rolling out the red carpet and inviting that innovation and get in the reps.
And those reps are not going to be, they start as puppies and they grow, but they're not going to be meaningless. They're going to be meaningful. And they are going to take over some of these incumbents and supplant them in the name. When we look at the roster of names, you know what I mean, from the 80s to the 90s to the aughts to where we are today. The top 20 businesses that the world thinks about as the best businesses in the world, that roster changes out all the time. You know what I mean? And it's cycling. And what we don't want, I say this as a U.S. centric entity, we don't want that to not include American names. It can't. You know what I mean? It cannot. And so this getting the reps, growing, and then how that's going to quickly come over back to the U.S. To exploit the largest market in the world. But I'm just going to use real estate as an example. Indian real estate and AIF funds in India in the next decade is going to be explosive. The capital formation that's happening over there right now is unbelievable. It's mind-numbingly big. And you look at that and you just go, this is going to, the big companies that end up over there are going to rival some of the biggest real estate companies in the world here.
Definitely. So, I'm going to get Richard's opinion in the last few minutes we have before we open it up to questions. One of the things that regulatory stability provides is a good environment for investment. You don't want to invest your dollars if the next day the rug can get pulled out from under you or the company you funded. So, Richard, what are the most interesting investments or trends in investment that you've seen in the Web3 space in the last, let's say, several months to a year?
I don't know, maybe Bitcoin ETF, fastest growing, ETF ever. Incredible inflows, a long run of daily inflows, breaking all kinds of records. Shows an interest in exposure to an alternative asset class with a bright future. But what's interesting about that is the investors who've put money in there could have put the money in there before had they opened a wallet at a crypto custodian. But the surety of working through a known asset manager and having them hold the assets rather than you having any part in key custody, is an important lesson. The investor protections that come with that, because otherwise, you're on your own. Your keys, your crypto, you lose your keys, you're done. The intermediaries is the asset manager stepping in to provide the exchange traded products, which have underlying holdings in digital assets, is interesting. We don't expect to see an ETH ETP this year. Could be wrong, but just don't expect that to happen. Believe it's going to take some time to reflect on what that approval and then the level of inflows and the ongoing performance means. But it's an event that can't be ignored, Kevin. So that's significant. The broader investment products that are investing in other Web3 picks and shovels, infrastructure stack, and those are also doing very well. So there's an interest in capital, a lot of retail capital, some institutional capital flowing to this ecosystem, but it's only possible because of the investor protections that exist, and that I don't think we can completely destroy and turn to a point-to-point, fully decentralized, self-sovereign investment architecture.
Wow.
Yeah. Richard, I mean, I just love everything you're saying. It's gold, right? Like we cannot tell you how much we appreciate you being here as kind of our lead-off guest for this 15-part series that we're doing. And I'm excited about, and I think reporting as the data is on chain, the ability to use tools like Inveniam and Elevator Labs for full life cycle of a retail asset, that's going to make reporting to risk books, et cetera, just happen at velocity and scale like there's no tomorrow, for the full life cycle of creation, development, formation, development, stabilization, delivery, and then into the asset life cycle, into the capital markets broadly for real estate is just going to be no brainer. But maybe Albert, I'll turn it back over to you. But Richard, I can't tell you how much I appreciate your viewpoint on this. And let me ask you a question. We talk about getting reps in the smaller markets, and then bring it back to the U.S. What are those reps going to do to those markets?
So interesting. It's unknown, right? This is a very, very dynamic, ecosystem, and the long-term implications of short-term decisions, such as allowing for innovation to move offshore into other markets, may have, consequences which aren't fully, understood or appreciated. Will ADGM become a significant, global market? Will they see more listings there versus the U.S.? It's the same question as, what did Brexit do with regard to, listing in the London market versus, European markets? Still too early to tell. I mean, there's been an impact, it's down, but, what are the long-term implications of, moving things to Singapore, moving things to ADGM? It's going to draw some capital It's going to enable the build of infrastructure, and the longer that it persists with development and growth in those markets outside the U.S., the harder it is going to be to attract that capital back to the U.S.
But also, I think maybe necessarily, let's just use ADGM as an example where we do a ton of stuff.
That's Abu Dhabi.
Abu Dhabi
Global Markets. Yeah.
Thank you. Sorry. Thank you, Kevin. I would suggest that's not going to really impact and take market share away from the New York Stock Exchange or NASDAQ. But it's going to impact AIM. It's going to impact the number of the Euronext exchanges. It's going to impact the Hang Seng for sure, right? Mm-hmm. It's going to impact Deutsche Börse and some of these, because all of these new markets, the Toronto Exchange as a metals and mining, center point, you know what I mean, has established itself with a brand and a niche, right? You look at what Abu Dhabi is doing, looking to in alternatives. It's in some places it's going to create something new, but it's really going to be taking market share from I think those smaller venues to begin with.
Could we think, Pat, about the markets as protocols, and that they, from a big central market, you're diffusing that activity across a number of different networks and protocols, and that the future of capital raising for companies to come to market will look more like decentralized finance than this centralized big market where you must list to get access to that capital, and that the interaction across those networks, so that you don't have fragmented liquidity, is the network of network architecture and the AMM and other interoperability architectures. I mean, it could be that we see what the things that are happening with that growth outside the U.S. market could be the diffusion of capital to a number of specialized protocols or marketplaces, which shape the market in the future.
Yeah, and the reality is that ability to aggregate liquidity across silos is the whole goal, right? How do we aggregate liquidity across silos? And I always use Saudi Aramco, right? When you get so big, you need to be listed in multiple locations. You can't just have a listing in New York. You need to list in multiple locations because you need that liquidity. You need that market making because your asset is so large. The reality is markets are going to form, and it is the network of networks. And how do we aggregate liquidity? And the more AMM and interoperability functionality that exists, the more we can deliver capital to achieve alpha, right? Democratize alpha, right? Where is the alpha, and why are we afraid to go to certain markets? Because we're afraid of the rule of law. We don't know how to gain entrance, et cetera. But on this interconnectivity, if we can go in with a name that we trust, your Bitcoin ETF anecdote, right? All of a sudden you have an intermediary that you've known who's now in a new jurisdiction. You can gain access to that jurisdiction just like you use that intermediary to gain access to a new product.
Love it. I just one last comment, and I know we're wrapping up. The listing on multiple markets is the thing that is done to compensate for the inefficiency of the global markets. Full stop. Right? That action, will no longer be required, because that is not a precursor for liquidity, right? AMMs and some of the other infrastructure primitives that we're talking about will solve for the unnatural acts that companies have had to do to get to get liquidity in different marketplaces. Fascinating. Great comment, Pat.
I would love to get kind of final feedback from Kevin, where you're not asking a question, Albert, Rick, but any final commentary, and then Richard, give the final word to you as we have about 6 minutes left. And Rick, I'm going to start with you. Any final comments that you have for us real quick?
No, I've enjoyed the conversation very much and enjoyed the opportunity to hear from you, Richard. Thank you very much. One thing that we didn't have time to touch on, but which I think is compelling and interesting is the idea of digital identity, not just for natural persons, like Richard described very eloquently, but for corporations, with many people with different levels of signing authority and different authority in different jurisdictions, et cetera. It's a big, complicated issue, but if we want institutional players to participate in these markets, it has to be addressed.
Yeah, thank
Agreed.
you. Albert.
Well, look, I'm going to echo Rick's comments. It's been a fascinating discussion. I think one point that is going to be important to keep in mind and will be fascinating to see is this is going to be a gold rush. AI was the current gold rush. Once DeFi starts to kind of break the dam, as it will, that'll be another gold rush. And who makes the most money during a gold rush? The guy selling picks and shovels. You see with AI blowing up, you see Nvidia turning into one of the most profitable and valuable corporations ever because they sell the GPUs that the compute happens on. So it will be very interesting to see who is the infrastructure provider in DeFi that allows that entire industry to exist. Whether it's the software, hardware, whatever it may be, it'll be a very interesting time to see what picks and shovels get purchased.
Yeah. Yeah. Kevin?
I wish we had time to talk about all 9 of the functions, the wallet, before and after, wallet custody, on-chain ID. I do like the fact there are 3 that Inveniam does in the verified data, price discovery, and some of that processing architecture and set rules. And I hope we'll have a chance to talk more about those in a future call.
That's wonderful. Yeah. Hey, Richard, we hope to have you back a lot. Boy, what a gift to have you here. And we're going to give you you've got the final 3 minutes, brother.
Pat, my pleasure. Always enjoy conversation with you and the team. Truly, I always learn something. Always challenges, perspective, which is kind of what this is all about. The closing comments I would make is that we're making progress. We're advancing the future. Comments about like who will be the infrastructure providers, Albert. We don't know who the winners and losers will be. It's still too early to pick those. And so what we do is we, support, all of them in their, effort to, build and support capabilities to enable this, financial market infrastructure replatforming onto, a blockchain architecture fully elaborated with the functionalities of a decentralized finance environment. I do think that I'll come back to, not sure how to get there, but we know exactly where we're going. We know exactly where we're going with regard to some of the first principles of transparency around, global access, around immediacy, around, low risk, around resilience, around trust, all of those things are there, but the details of how they play out, for instance, and I'll just leave this, one comment that we didn't, bring up or topic, a lot of people in the ecosystem talk about, DVP, delivery versus payment, and atomic settlement of trades. That doesn't work for the institutional markets. You need netting. You need to be able to have a netting infrastructure. And I don't see, a netting design, emerging so that large, hedge funds or, other institutional traders can, participate in the activity to provide liquidity and take liquidity and create, liquid markets without doing, atomic settlement against each of those trades. The system would just cease to operate. It would freeze up. So there's still a lot of work to do. There's still a lot of reps to get in. There's still, many design elements that are not yet perfectly clear. We've discussed many of them here today. But I can say we're 5% there, which is halfway done. There's Singularity University talks about, exponential steps. And their view is, 5% done is halfway there if you look at it in an exponential way. And I think that we're on track. So thanks for the work that you're doing. Thanks for having me here today. And look forward to potentially doing this again in the future.
Awesome. And we have just a reminder, next week we're going to do Navigating the Multi-Chain Universe. We got a bunch of great participants on that one. How will this multi-chain world operate? How will markets form? And we're going to have a number of the chains on themselves, giving us their worldview. That one should be, I think, full of fireworks. That one's going to be a lot of fun to be on. Guys, thanks everybody for joining us. God bless everybody. Bye-bye.